This is Money Mindful by Hansi Mehrotra on CampusGal.
Hey CampusGal, what if I told you that you don't have to sacrifice having a good time in order to save some money? Because, let's be real, you deserve to be living your best life without the money stress. So stay tuned to Money Mindful, where we give you some sure-shot strategies to build some healthy savings habits, crush your finance goals, and still have a ton of fun along the way, because YOLO.
Hi. So, you've got savings, and now we need to turn them into investments. How do we do that? When we consciously or mindfully take money out of our bank and put it into more productive use, like shares or bonds or real estate or anything like that, that is called investing. Ready to go? Let's get started. So, at its very basic, investing means giving money to a business for a return, of course. So, how do you do that? So, the first way of doing it is that you lend the money to the business and they promise to give the money back to you. You both agree on what interest rate you're going to charge them and at what intervals they're going to give you coupon rates or interest, and then when the principal is going to come back. That is lending, or it's also called investing in debt. The other way is that you take a silent partnership or take a stake in the business. That means that you participate in the profits and the losses at a predetermined proportion. So somebody could say that you now become 1% of the business, or you become a 2% owner of the business, or 5%, 10%, whatever the number is. The point is that you become a silent partner. Now, silent means you can't just tell the management or the person who's managing the business what to do. You have to pretty much go along with whatever they do. Also, they don't have to give you a dividend. They can choose to give you a dividend if there are profits, or they can choose to reinvest the dividends for further growth of the business. They can acquire other companies. They don't have to ask you for permissions. So when you are investing in an equity stake in a business, you have to be very careful that you trust the management. Actually, you have to trust the management even when you're investing in debt, because you do want your capital back because your returns are lower. Now, they're the two basic forms, debt and equity. Now, what if you say, but I don't know how to select good management or decide what is a good business and so on? What do? Well, you can give it to other intermediaries. So, for example, when you leave your money in the bank, what do you think the bank does with it? The bank also lends the money out to other businesses. But here, you are not involved in selecting which business and what interest rate and so on, right? So the bank is taking the risk. So you just have to trust the bank. But they give you a low return for that. So they take a big margin. So if you want to participate in the higher return, but you still don't know which businesses to select, there is another way. It's called mutual funds. So mutual funds are basically vehicles or structures where you pool your money with other retail investors, basically, mums and dads, you and me, and we give the money to this company, this asset management company that manages the mutual fund, and they go and buy the equities or the bonds and so on. They get the returns, they keep a fee in the middle, and then they pass the returns back to you. Now, mutual funds are a look-through vehicle, very different from the bank. The bank takes the risk, so therefore you get the lower return. In mutual funds, you take the risk, therefore you participate in all the returns, minus the fee, of course. So basically, financial assets are equity and debt, and you can invest through vehicles or through structures called financial products and the most common one is mutual funds. Now, equity and debt are financial assets. There are other assets called real assets. What does that mean? That means you can touch and feel those assets. The most obvious that everyone knows about is real estate. So what is real estate? You are actually taking an equity stake. You're taking a stake in a building. Okay, it could be a whole building, it could be an apartment like this, it could be a shop, it could be an office, it could be a parking lot, it could be anything. It could be basically a building. It could also be land. It could be just freehold land like a farmland or just open space that you can build later. So when you buy that real estate, you're basically taking a stake in it, usually 100%. That means that you participate in the profit and you have the losses. Now, you can, of course, pool your money with other investors and invest into real estate. Those are called real estate investment trusts or REITs. There are also real estate mutual funds. There's also real estate alternative funds. We'll discuss that later. The point is that you are investing in something tangible. What you have to think about is that whether that property, that real estate, will always have tenants and therefore give you a return. It is possible that things change. Maybe the street has an issue, maybe the whole city has an issue, maybe the building has an issue, maybe all kinds of things will happen, okay? So don't assume that real estate is the safest thing and you'll always get a return. Now you might say, surely the capital values will always go up. No, that's not how it works. At some point, the value of the real estate is a function of how much rental income it will get in the future. So if there's an issue with the rental income stream, then there will be an issue with the price at some point. Now, what's the other real asset class? Another thing that we all know about, and that's commodities. So it could be gold or silver, hard metals that we wear as jewelry, but it also includes things like agricultural commodities, so wheat and dal and coffee and sugar and things like that. It could also be things like oil. So a bunch of commodities around the world that are usually dug out of the ground or mined or somehow taken out of the earth, and they're usually used for consumption purposes. Obviously, of course, for industrial purposes as well, but the point is that commodities are a natural resource. So there you have it. The two real asset classes are called real estate or property and commodities. So we've discussed financial assets, equities and debt, and real assets being real estate and commodities. These four things, these four groups of assets are called asset classes. They're basically classifications of assets that behave very similar to each other. What does that mean? That means, for example, if you invest, say, in a bank stock, say XYZ Bank, you could invest in the equity or in the debt. On any given day, the equity price of that stock will behave more in line with what the stock market is doing, whereas the bond that you buy of that bank will behave more in line with what the bond market is doing. Now, the bond market is more influenced by things like interest rates and inflation, because they're the only variables that really matter in the pricing of a bond. On the other hand, the business, the stock price, is affected by many, many more factors. And that's why something as far away, something happening overseas could affect the stock market. It can affect the bond market as well, but invariably the equity prices are affected by many more things. Those are called the equity risk premium. I know, technical term, we'll come to it later. The point is that they're the four asset classes, and asset classes means that they're grouping of assets which behave similar to each other and different from the other classes. Now, asset classes are different from products. Products are basically just legal structures that wrap around the asset classes. So when we talked earlier about not wanting to pick stocks yourself and you invest through a mutual fund, Notice I said invest through a mutual fund. That means that actually we are buying stocks or a portfolio of stocks, but through a mutual fund. So the mutual fund is a product. It's a legal structure that's giving you exposure or access to the underlying asset class, which is equities. Of course, if the professional fund manager is doing the good job, they will of course charge their fees. That's fine, but the product simply gives you access to the underlying asset class. Why am I saying all this? Because sometimes people say that mutual funds are risky, or mutual funds are this or that. Mutual funds are not any of that. They are just the wrapper. They can't have risk and return of their own. They take the risk and return of the underlying asset class that they're investing in. So if someone tells you mutual funds are risky or not risky, or high return or not return, it's just they're using the term colloquially rather than technically. Now, asset classes can be further subdivided. In technical terms, we call them segments, but again, in common usage, people might refer to them as asset classes as well. So for example, equities could be further subdivided into large cap, which is the biggest 100 stocks, mid cap, the next 100 to 150 stocks, and then small cap, which are the smaller companies that are still listed on the stock exchange. I would call them segments, but there are other people, like I said, that call them sub-asset classes or sometimes just asset classes. Frankly, what you call them doesn't matter. What you have to be conscious of is why they do that. They do that because the risk and return starts to vary. So if you invest in stocks, whether it's a large cap, mid cap or small cap, it will be affected by the stock market movement, but maybe small caps would be riskier because the companies are smaller and they might not be able to weather whatever the adverse news is. So yes, it could affect the small caps more compared to mid cap, compared to large cap. But let me tell you this. Just because you further subdivide the asset classes does not mean that you are getting more accurate in your predictions or in your diversification. Okay, so it's better to be vaguely right than precisely wrong. So broadly, if you have exposure to equities and debt, and then real estate and commodities, you are reasonably diversified. If you go into sub-asset classes or segments, as I prefer to call them, you are getting some more diversification, but it starts to not have that much benefit. Another question you should ask is, why diversify? The answer is because different asset classes behave differently, because they are driven by different factors or drivers of returns. So, as I said earlier, debt is driven more by interest rates and inflation, whereas equities obviously relies on corporate profits. And corporate profits in return relies on many other factors, whether the government is favorable or not, the foreign exchange is happening or not, the business environment, are we in a recession, or what other part of the business cycle we're in. So many other factors. So depending on the type of factors the asset class is affected by, the returns will be higher or lower. Now, in the short term, returns can be all over the place. We'll discuss that another day as to why that is. But long term, there is a hierarchy that most markets follow. And that is the lowest return goes to lowest risk. So that is cash. Cash is an asset class that is basically fixed interest, but for the short term, so less than 1 year. So cash has the lowest return in line with inflation. Then you have fixed interest or debt, and I mean government debt. Then you have slightly higher return, that is corporate debt. We can discuss that as well. And then you have real estate, and then you have equities. So that's the hierarchy of returns over the long term. In the short term, as I said, there would be many reasons of why the returns do not turn out to be as smooth or as hierarchical or as in line with risk and return as you think. That's because finance is not like physics. I think I mentioned that in the first episode. Anyway, so in finance, things don't quite work as smoothly. We can discuss that in greater detail in another episode. So in conclusion, we have discussed how to turn savings into investments. Simply put, you have to give it to a business for productive use. It's capital for them. They will put it to productive use and give you a return. Depending on what the contract was, you can either lend the money and get a lower return, it's called investing in debt, or you can take a stake in the business and get a higher return, but it will be volatile depending on the profits of the businesses. So that's the equity return. There are other real assets called real estate or property and commodities. So they are the four major asset classes in the world. You can invest in all of them. You should invest in all of them to get diversification. But I totally understand that you may not want to. You may have a day job or you just don't enjoy doing this. So you can invest in products. Financial products like mutual funds pool money from retail investors and then invest them into these asset classes. Mutual funds are look-through vehicles, which means you will get the return from the underlying asset classes, just minus the fee that they charge. So there you have it. You turn savings into investments by investing in asset classes through mutual funds. Hope that made sense. We will go into much more detail in future episodes, so keep watching.